Welcome to the Monday edition of the On the Tape podcast. Guy Adami here. I'm always joined by Dan Nathan. Dan, how are you?
I'm doing great, Guy.
Elizabeth Young Thomas, she of SoFi. I know you're well because the Packers of Green Bay are just steamrolling the rest of the league. If they were in any other division, they'd be sitting at a top, a perch, looking down at everybody else. But of course, the Detroit Lions are kicking everybody's ass. EYT, how are you?
I am fantastic. You're right. Steamrolling they are. Beat the Niners yesterday. The Niners have taken us out of the playoffs. It seems
Yes.
like every year for my entire life. So it always feels good to beat the Niners.
Does a by the way, a injury riddled Niners, but you know what? In the NFL, nobody cares. Nobody cares. You
What do
play
you
who's
say?
on
You
the
don't get
schedule.
points for style?
No, you
Something like
don't.
that? A win's a win.
Speaking of style, Dan, the market is styling and profiling this morning
Oh
as
my
we're
God.
sitting here. S&P futures up again, and my sense is it's on the back of the announcement we heard for the Treasury Secretary, which I got to tell you something. It was either him or Kevin Warsh. Both of them were sort of 1A and 1, and you know what? I think in this case they got it right, Dan.
Yeah, I mean, listen, relative to some of the other picks, I think this was the one that a lot of market participants were most focused on, obviously, and really there's probably some interplay with how it might work with the Fed. I just can't remember the last time I saw like a personnel, decision, even going back to 2017 or I guess late 16 during that transition that could cause 75 basis points opening in the S&P 500. I mean, the market's just raging. And Liz, one of the things that took me away, Friday afternoon, I was messing around a little bit doing other things during the market, and I looked up at 2:30, and just the way that banks and anything else financially oriented was raging, it was kind of intimating, I think, something about who that Treasury pick might be.
Yeah, the market definitely anticipated it, and the market anticipated it correctly. I think we found out the announcement came out sometime early dinner time on Friday night, and here we are about to open on Monday morning, and I think a lot of enthusiasm, more wind at the market's back, if you will. And I think we already had a decent amount of wind at the market's back, especially from what we would consider a Wall Street perspective and a banking perspective, the expectation of lower regulations and just higher growth, more cyclical activity into 2025, and now what people are taking as a friendly pick for business activity as well in 2025. So I think that this rally, if there was any question whether or not the rally could continue through year end, I think this Treasury Secretary pick reduces the question mark.
No question. I think, listen, we're going to learn a lot over the next couple of weeks. This week is a tough one to gauge, obviously, because it's a, excuse me, holiday shortened week. So I don't want to put a lot of stock into what yields do and stuff. But, we're going to know a lot more in the next couple of weeks, whether or not the bond market wants to continue to sell off and yields continue to move higher, or if that sort of 4.5%, Dan, we saw a week and a half or so ago, is the top for the foreseeable future. Now, I want to be crystal clear. I'm still one of the people out there that thinks yields are going higher, and this is just a pause. But with that said, I think the market's going to take a lot of cues over the next couple of weeks in terms of the direction for the beginning of next year.
Yeah, and I guess it comes down to what is your view on inflation? We have the Fed's most favored inflation reading later on this week. I want to go back to Bessent because I think this kind of wraps up this conversation a little bit. So the knee-jerk reaction, right, is to send yields lower on the 10-year here. And, this is something, Liz, that I'm reading this from the Wall Street Journal. Bessent sees a coming global economic reordering. And so he's talking about, this policy of 333. They call it, it was Abe's in Japan, his three arrow. The three arrows include getting the budget deficit to 3% of GDP by 2028, spurring GDP growth of 3% through deregulation, and producing an additional 3 million barrels of oil or its equivalent a day. I think that was kind of an interesting sort of thing. But my question for you is that if you get policy going towards 3% GDP growth, right, you extend the tax cuts, isn't that massively inflationary? Obviously, the oil thing is to bring down, I guess, the cost of oil, right? But this just speaks to greater demand in the economy. And wasn't this exactly what we were dealing with in the second half of 2020 and most of 2021, where we saw inflation get going off of very low levels? Now we have this cumulative standpoint or, set up from the last 4 years or so. And now if you do all of this, isn't this massively inflationary?
I think over a longer term period, perhaps. But what the market is reacting to today is two tenets of what you just mentioned. So as 10-year yields crept up to 4.5%, markets started to get nervous that beyond 4.5%, it was happening for bad reasons. And two of those big bad reasons were that the deficit was growing and getting out of control and was going to keep getting higher, or that inflation was reigniting and we weren't going to keep our arms around it. The Fed was doing something wrong. So if there are two tenets in what you just stated, that the deficit might get more under control and that oil prices come down, keeping inflation more under control, there's a little bit less nerves in the market today. So I think you're seeing this fall in the 10-year because of that. Also, Guy, I don't know if you've noticed, but the twos tens is inverted again.
Yes,
Less
I
than one
believe me,
basis point now.
crystal laser focused.
You were the first one who noticed that. So we're inverted again at the twos, tens. I think this is the initial knee-jerk reaction that, okay, maybe deficits are not as big of a problem, maybe inflation won't be as big of a problem. And not only the fear of inflation becoming a problem because of oil, but if we're producing more, now it's not as easy to just say, like, go produce more barrels every day. You have to find where to do that from. You have to, there's a lot that goes into it, and there are costs that go into that. But if we're producing more, that means we're less reliant on oil imports. We're less sensitive to tension in the Middle East. I think a lot of that is baking through into what's happening in yields today. And that's fine. That's all logical. But Dan, to your point, if we stretch this out over a longer term period, yes, I think in theory, tax cuts will spur consumption. And if we spur too much consumption, then you run the risk of demand again outstripping supply, in which case inflation reignites. What I wrote about a few weeks ago when we got the last CPI report was that so far, yes, inflation is still maybe a little bit of a problem, but it continues to be the usual suspects of housing and car insurance. So we have to watch the numbers both in PCE and CPI. Where is it coming from? What are the drivers? If it starts to be the consumer again, I think we get into a little more trouble.
As Dan said, PC on Wednesday, which I think is going to be interesting. We'll see the interpretation of the market. Again, I don't, it's a tough week to sort of gauge things because with light trading, things seem to typically levitate. Risk assets typically do well in weeks like this. So we'll see. But that should be an interesting number as we go to Thanksgiving. The other thing that Liz just mentioned, which I think is really important, is the fact that once again, whether we're flat or inverted, the fact that the 2-year yield, Dan, has gone as high as it's done since the Fed cut rates in September is the real sort of eye-opening sort of head scratcher to me. 10 years makes sense, 2 years not so much, Elizabeth. So I'll ask you, I mean, does in the context of what we've seen historically, this sort of reinversion, I guess, of the yield curve, I don't really know what to make of it. And quite frankly, I bet you a lot of these Fed heads can't figure it out either.
Yeah, I don't know that the market knows what to make of it. And the 10-year, I think even there were quite a few technical factors at play too. Once it knocked on 4.5 store, you saw buyers come in. So there was more demand, and that's something that drove yields back down too. So I don't think it was just a pure economic play or a pure Scott Bessent play. I think there was some technical factors that made it attractive at those levels. But to your point, the 2-year rising as much as it has since the Fed started cutting rates doesn't make a ton of sense when you just look at it broad brush. But we know that since the beginning of 2024, the expectation of rate cuts has come down from 6. Now we're probably going to see 4. We're only expecting in the market 2 cuts for the entirety of 2025. And I think there was actually a firm, somebody at maybe it was Goldman, I might be wrong about that, who is coming out saying that no cuts might happen in 2025 if growth reignites the way that people are expecting. So since the 2-year tracks what the Fed is going to do or what people expect the Fed to do, that sort of makes sense to see the rise in the 2-year. But at some point, and so far I think it's been 4.5 in the 10-year, at some point, equities will not like that rise in yields anymore. And the Fed won't like that rise in yields because it constricts activity too much and starts to work against them.
Well, I tell you, Goldman Sachs doesn't seem to care, Dan, because Scott Rubner, who I am not familiar with, but he has a note out saying retail euphoria is accelerating across equities and crypto, just as stocks enter their best seasonal trading pattern. Corporate demand for buybacks is also increasing, adding why he thinks there could be a year-end rally in the days to come. The consolidation phase seen all last week is typical. And then he says, historically, good years tend to follow more good years for equities. January is when capital gets deployed from the largest asset base. He's placing his order for an S&P 7,000 cap now.
So he's saying clock a ticket there, Guy. It's interesting to me about this, and you think about, okay, what you guys just mentioned about rates. So if rates remain somewhat restrictive, but you've had this kind of 2-year consecutive 25 plus gains, right? And you just mentioned what Goldman's suggesting for that third year. Think about crypto that has doubled in the last 3 months or so. So that's $1 trillion that just kind of made its way through the investing public. Now, all of that's not here in the US, but you have an S&P that's up 26%, a NASDAQ that's up 28%. You have a wealth effect that's been created here, right? And then tack on the potential for the 17 tax cuts to be made permanent, right? And you say to yourself, and you keep hearing, I know, Guy, this gets you crazy, this term animal spirits and the like here. Are we reflating an asset bubble that reminds us very much of 2021? Because the other thing I'll just mention to you is that think about all of these IPOs that are going to come to market. Think about some of the very aggressive, M&A activity that's going to come to market. That's not too dissimilar with a crypto frenzy than what we experienced in 2021. And we know that 2022 was a difficult year, but it's hard to consider the fact that, everyone's so bullish right now, whether it be on markets, whether it be on the economy. It's soon going to be the housing market, despite mortgage rates not going lower. Commodity markets should go crazy. Maybe folks are going to start to think that China, maybe a slightly more difficult rhetoric with them on the tariff front, leads them to kind of believe that they can be, once again, a greater participant in the global economy. And all of a sudden, everything is coming up roses here, So again, that's the scenario that I think all of us would get nervous about because it brings us back to 2021.
It's interesting, Elizabeth. Dan mentions China and tariffs. I don't think a lot of people realize. I sort of knew it, but I didn't know to the extent. Over the last year or so, Mexico is now our biggest trade partner. We import more from Mexico than any other country. China and Canada, by the way, are in a dead heat for second, and it looks as though at some point soon Canada will take over for that. So tariffs are important, but I think what the market, or maybe what some of us don't fully comprehend, is China doesn't really have the same standing in terms of our relationship just on the export side that one maybe did 4 or 5 years ago.
Yeah, well, I think the important takeaway is that tariffs work to change basically the world order of how trade happens. I don't know that they've worked so far to make us entirely, more nationally protective in the sense that we're self-sufficient, producing all of our own goods and services. We're still importing. We're just importing from different places. So tariffs do have an effect. And I would say going into 2025, then I think we should probably bank on the expectation that we're going to hear a lot about tariffs and that there will be some changes and there will be some implementations of tariffs. There have been some really big threats of 60% tariffs, and I think it would be tough to get that through at this point. But I think we should expect that there will be some volatility because of it, and we can really affect what comes from China, what comes from Asia, no matter the country that we're targeting, we can actually affect it, especially over the long term.
Yeah, and this goes back, Guy, to the first Trump administration. Remember, they had this bugaboo about NAFTA, right? And NAFTA goes back 30 some years. And what we saw with NAFTA, obviously, is a lot of manufacturing here in the U.S. moved to places like Mexico and Canada, as you're, discussing this. And, not too long ago, then candidate Trump was threatening a company like John Deere with like a 200% tariff in an effort to get their manufacturing back to the U.S. And I guess the thing that we've been talking about reshoring for the last few years, right, as it related to supply chain disruptions, about COVID and the like, I mean, this is all really inflationary too, right? So think about this. You don't even have to throw tariffs on China. You can threaten them. And I know some of the comments that Bessent had about the tariff gun, and he was speaking, this is earlier in the summer, about how it's really a instrument, right, to get these folks, going in the direction that you want them to. But with Mexico and Canada, it's a much harder sort of proposition, right? Because the idea of John Deere bringing manufacturing back here to the U.S., well, all of that machinery becomes that much more expensive, right? The inputs to making that material, that machinery, obviously, the creation of that, the labor as it relates to. So this is not easy stuff. And when you think about that three arrows and you think about some of the the stuff that folks think is setting up this global reordering of the economy near term. And Musk said this recently. Near term, there could be a lot of pain. So that could be a headwind to some of the things that at least the markets are interpreting right now.
No, we're gonna find out. I mean, it's really interesting to me, Elizabeth, that this market just continues to sort of do the levitation. I think RBC just had a note that they think that the S&P could get to 6,600 in 2025, but they expect a 5 to 10% correction prior to that. Which, a lot of people have made similar comments, which is all well and good, and I think it makes sense. But the market doesn't seem to be picking up on that right now. The VIX we have back down either side of sort of 15 or so. All fear seems to be taking out. Geopolitical risks seemingly don't matter. Yields going higher, yields going lower. None of that seems to matter. This sort of levitation we continue to see in the S&P 500 sort of belies the fact that there are a lot of concerns out there that nobody's really seeming to pay attention to.
So there's something that my mom has said for my entire life, especially around the holidays.
Liz, get your act
Yeah.
together.
Now, she says
Oh,
all
no,
this.
no,
I
no,
was
no, no,
always
no,
on the good
no,
list.
no, yeah.
You have to believe in order to receive. And the power of belief is very, very strong. And I think right now, to your point, Guy, no matter what the headwind is, no matter what the commentary, no matter what the risk, no matter how dislocated some of yields seem from things, no matter how dislocated some stocks seem, no matter how overblown, the belief that we are going to be okay and that the soft landing has happened and that everything is going to get better in 2025 is completely overpowering anything else. And I think that will continue for a while. So this, even if it seems completely irrational, the belief I think will get us there. Now, about the price targets that we've gotten and even the commentary that we might have a 5 to 10% correction in between, here's the other thing that's happened in the last 2 years. In 2024, we did have two 5%-ish corrections, right? The one in spring was a little less dramatic than the one in August, but we had two 5% corrections and we got out of them seemingly unscathed, as if they never happened, and then went up, reignited a rally on the other side. So when people hear we might have a 5 to 10% correction, it's like, sure, go ahead. That's a great buying opportunity. There's still this buy the dip mentality. We have not revisited, and I don't see us revisiting it, especially before year end, a time where normal numbers will come into play. So a normal correction in the S&P on an annual basis is about 14%, 13 or 14%. We haven't seen something like that in a very, very long time. I think if we got above 10%, people would start to freak out a little bit because we're just not conditioned for it anymore. So it's this belief that we might have mini corrections here and there, but we'll get through them, no problem. Everything is fine. The market will continue going up.
Listen, Dan, one thing that has been fascinating for myself is waiting for Nvidia last week, seemingly, the hand wringing that went on. They report earnings last Wednesday. The stock basically doesn't move. In the subsequent days, it makes a new all-time high north of 152. But here we are trading below 140. I do not want to make a big deal out of this at all. But the lack of volatility around Nvidia is interesting. And maybe for the first time, the lack of a really robust response to the upside is interesting as well. Now, the S&P, again, doesn't care today. Nvidia is lower today with the S&P higher. However, I think that's something to continue to watch.
Yeah, no doubt. I mean, the headline this morning is that Amazon, and we've been mentioning this for months and months right now, Microsoft, Amazon, a lot of their biggest customers are designing, high-end GPUs for their own data centers. And again, because the reliance on just Nvidia has caused the pricing to go through the roof, right? We've talked about these 75% gross margins. Nvidia has had crazy pricing pressure. So maybe that's the headline that's causing some sort of trepidation. I'd also mention that Taiwan Semi's down 2% today. On the heels of that, those two stocks, which make up 35% of the SMH, the ETF that tracks, the semiconductor group, are obviously very, very important. They're the ones leading the way here. And I'll just mention this, that I think tomorrow after the close on Tuesday, Dell, which is obviously a big customer of Nvidia, is reporting earnings. So I think that whole sort of ecosystem, it's interesting to keep an eye on. And to your point that this stock could be acting this poorly a couple days after their earnings, and the S&P and the NASDAQ are making new highs is definitely notable. Could this disconnection, you know what I mean, this dispersion continue to go? Sure. But at some point, the way Nvidia and Taiwan Semi go is the way that this whole, ecosystem is going to go, and then possibly the NASDAQ guy.
Well, I'm glad you mentioned Dell, because this has been, again, this is a $100 billion market cap company. This was a stock that traded, I want to say, Dan, almost $180 in the spring of this year. It subsequently was cut in half, more than cut in half, by the way. Like many stocks, on August 5th, it bottomed out. And now we've seen almost an 80% rally in this stock that nobody is talking about since that August 5th low. So I'm going to be honest with you. I don't know if the setup into earnings is good or if it's bad, because given the run that it's had, it really has to say something interesting. And, this seemingly was winning, Dan, on the back of what we heard about Supermicro. But with that said, Supermicro's probably rallied, 60 or 70% over the last week or so. So a lot of sort of mixed messages out there.
Yeah, and the one thing we can just kind of put a bow on this thing. Micron was also one of those names. Obviously, the memory that goes into these servers that go into the data centers. That stock had a very similar move. It went from 158 in June down to, I want to say, the low 60s, and here it is. It's trading at to the low 80s. Here it is at 105. It's still trading below these levels that it got up to, 115 or so. So this one's not acting particularly great. It'll be interesting to see what Dell has to say, their guidance. Liz, maybe you can help us on this one. Guy has been talking a lot about this, kind of K-shaped recovery as it relates to consumers, right? And we think about, a Dollar Gen, a Kohl's, these stocks are trading like unholy death, right? So on the lower end consumer, but on the upper end, if you look at some of these, look at a Best Buy, or look at, some of these other department stores like a Nordstrom, they're acting pretty well. And so we got a bunch of earnings this week. I think Best Buy will be really interesting as it relates to, holiday spending, but we do have Nordstrom. We have A&F. There's a few others here. The one that I find really interesting, and maybe, Guy, you'll be able to comment on this after Liz gives us a setup for the retail and really the consumer. Macy's pulled their earnings for tomorrow morning. An employee was hiding a bunch of expenses to the tune of maybe $150 million. And it's kind of this environment where you start seeing some of these sorts of, I don't know if you want to call them frauds, kind of come out. So that's how we're kicking off this earnings season. And then if you go back to last week with Target, that down 20% move because of inventory issues, it might end up being a rocky sort of period, Liz, for retailers.
It could be. Right now, the vibe is that people are spending and that holiday shopping is already off to a good start. And as we know, Black Friday starts in October at this point. So it's already happening. People have already been shopping for over a week for the holidays. So I'm going to read the definition of the wealth effect, because I think that this is really important in your question. The wealth effect is a behavioral economic theory suggesting that people spend more as the value of their assets rise, even if their income does not. So what does that mean? Why does that matter for a K-shaped economy? Because who are the people that have all these assets? It's the wealthy people that have the assets. So they're the ones watching their assets rise. Income perhaps hasn't changed much. And we know that income growth has not kept pace with inflation over a cumulative period. So it's not the income that's changing things. It's not the income that's making consumers spend. It's the fact that watching their brokerage account balances rise continuously is helping people spend. So I think that's the big driver between this K-shaped economy. What I think we might see in this holiday shopping season is perhaps more inventory mismanagement. And I'm going to defend retailers here a little bit, because it is tough to try to forecast that out. And they have to forecast their inventories out further in advance than they can really understand what consumers are going to do about it. So if consumers change their tastes, change their behavior, change their patterns of where they're even shopping, retailers have a really hard time keeping up with that from an inventory perspective. The thing about it is, though, we won't know about these inventory problems until January or February. So it's going to take a while to find out which retailers did it well and which ones did not. So the discounters, you mentioned Kohl's. Kohl's is based in Menominee Falls, Wisconsin.
Well,
Fun
it's
fact.
I summer there.
Oh. That's
Lake
strange,
country.
very landlocked city. I don't know that I would suggest that. Anyway, I have a soft spot for Kohl's, but you're right, Dan. Some of those discounters have not done well. And it's interesting, though, because the likes of Walmart have done very well and Costco has done pretty well. So some of the discounters are doing well, I think, because just managing their inventories, managing the flow of consumers through, and really holding on to their consumers. And they have this base that is sticky and loyal. And I think that matters in an environment like
All
this.
right, so quickly, let's talk about coal since you mentioned it from that wonderful town in Wisconsin. I mean, this is a stock, by the way, that in 2018, I think, made an all time high, probably north of $80. Not that that's all that interesting, other than the fact that since then, it's been basically upper left, lower right. And as we're sitting here today around $18, Dan, you have a stock that's basically trading at the same levels, the lows that we saw in the fall of last year, in October of last year, and at some point precariously close to levels that a lot of stocks saw, obviously in that huge sell-off in the spring of 2020. Does not trade well. That's one end of the spectrum. Target sort of being middled. Target, a lot of their problems are target specific. They're just not operating well. But when you have a Walmart, which today made an all-time high, a Costco, which last week made an all-time high, now 75% of Walmart's customer bases earns $100,000 or more, which I do think is interesting. You throw a Williams Sonoma, which is obviously the other side of the equation, making an all-time high last week, and the dollar store is effectively trading at 52-week lows. I mean, that speaks to the wealth effect, that wealth chasm that I've talked about for years. They're the have and the have-nots. And if you're in the middle in retail, Dan, right now, you're getting smoked. If you're on the lower end, you're getting smoked. But if somehow you can sort of garner that higher earner or sort of the middly earner that's trading down, you're in the catbird seat.
Yeah, no doubt. And again, Liz, to your point about the Black Friday starting in late October, it means that we're going to have a heavily promotional sort of holiday season, right? And so I have to think that these retailers hate having to report earnings the week of Black Friday, right before Thanksgiving, and have to give guidance, because the Target example that Guy just gave is that it is hard to manage your business right now with all of this economic uncertainty. Obviously that shifted over the last few weeks to something very positive. And I guess before we get out of here, I just want to mention this, and maybe all of us can kind of point to one thing that we're watching this week. It's not too often that you see the major indices have big gaps up or down. So the day after the election, we had one in the S&P 500. We had one in the NASDAQ. And some of the single names that we look at, they were much bigger than that of the indices, right? And we know that most gaps are meant to be filled. Our main man, Carter Braxton Worth, he often brings charts about unfilled gaps. Well, here's the biggest one that we've seen since early August. And when you look at a lot of the single names that are driving a lot of the enthusiasm about the stock market, I mean, they are going parabolic right now. And so you have to assume that you're pulling forward a bit of excitement. We're seeing multiple expansion here. And at some point, the Guy and your point that you guys made earlier about 25 minutes ago is that if you have rates stuck here in that 430 and the 10-year, and you have this inverted yield curve of the 210, at some point, I'm not sure how much more multiple expansion you can get if we do not get towards that 3% GDP growth, Liz.
Yeah, and spoiler alert, in my 2025 outlook, you're going to see charts about multiple expansion. And I did it in the piece that I wrote about semiconductors and software last week. There's been about 1/3 of the price gains that we've seen in semiconductors has been driven by multiple expansion. Now that means that 2/3 of it has been driven by earnings growth, which is good. We want to see the fundamental support behind it. But that other 1/3 is really fragile. And that goes for any industry, any stock. When it's driven by multiple expansion, the market gives that back very quickly in a time when it's changed its mind about that particular growth metric. So be careful when you're buying things that you can look at and say, I know that a lot of this has happened based on enthusiasm. If you're looking at a company or an industry that there hasn't been a lot of new news on in the last few weeks and you're chasing, you have to sit back and question. Now, and this is a portfolio management thing, and everybody's going to do this a different way, but something that I would tell people to try to do a lot of times, if you're going to just initiate a position, start small. Do it gradually, right? Just get in the position and then watch it move over a couple weeks, because you might get a better opportunity on one certain day to add to that position. So don't throw all your chips at one basket on a day like today, where everything is running, and the stuff that's running has already seen this parabolic move.
As Matt Damon said in Rounders, you shouldn't ever really throw the chips, number one. Number two, what I'm looking at here, Dan, it's going to be on Wednesday. Initial jobless claims at 8:30 and then pending home sales at 10 a.m. I know that seems sort of out from left field, but it's going to be interesting to see what numbers get snuck in ahead of Thanksgiving. So those are the two things, amongst other things, that I'll be watching, Dan Nathan.
Yeah, and then I'll just throw this out there for me. I know all of us are kind of watching this, experiment with MicroStrategy. So as we're speaking, it's down 5%. Let's see how crypto that, Bitcoin tried to get through that 100,000 mark, and it seems like that was one that folks were really getting excited about. If you saw a turn in crypto, if you saw a levered play on Bitcoin like MicroStrategy have, and I think, Guy, you mentioned this on Market Call last week, that reversal that we saw from that huge gap, that might be a sign, not too different than 2021, that some of the excitement around high valuation tech stocks might be coming in. If you have, an Nvidia starting to really underperform, on a relative basis, the NASDAQ and the S&P. Those are the things that I'm most focused on. But Guy, with some of the excitement about the Bessent pick and the like here in the market's reaction, I just say, how do you like them apples?
Oh, I see what you did there. Speaking of apples, Elizabeth makes a unbelievable, apparently, apple pie with like homemade the crust and the crumble and all
Yeah.
those things. Maybe we'll
I've
put
made
that
this
in the show
pie.
notes.
I don't know how many times I've made this pie, but yes, I make it every year. And every year I try to figure out what type of apples are going to make it better. And I agonize over what kind of apples to put in. And you know what? Tastes the same no matter what apples are in there.
That's
Wow.
interesting.
But it's always good. It's
It's
grandma's
always good.
recipe. I never change it. It's been the same for many, many years, and I'll keep it forever.
Before we get out of here, I want to ask you one question. Are you somebody that likes vanilla ice cream with your apple pie, or do you keep it you want it to be pristine in its apple pie form?
I want it to be pure and pristine in its apple pie form. I might warm it up a little bit. Occasionally there's ice cream involved, but if given the option, I usually keep it just clean apple pie.
But by the way, Guy, we have a special drop on Wednesday of the market call.
Stop
Liz is
it.
going to be with us at 9:30 a.m. And I got to say, I wish we were kind of at her home as we were doing this remote, because the smell coming out of that oven, you know what I mean? A little cinnamon, a little apple, a little nice pastry, that sort of thing. So 9:30 a.m. special live market call. Liz Young, Guy C. Adami. That's going to be hot.
With all the tech geeks out there, it's just a matter of time before we have smell-o-vision, which would be problematic for some homes, but that's for another show. Elizabeth Young, Thomas, Dan, Nathan, thank you. We will see you soon, later today, on the market call. So enjoy the rest of the day, folks.